We always like to hear from our listeners. We received a question on YouTube, which I'd love to ask you, and then I'll answer it myself, which is when evaluating a stock idea, do you have any favorite metrics you use to determine the stock's relative value? And there's a second part to this, which is with all of the announcements in capital expenditures from the hyperscalers and sovereign nations on data center buildouts, the numbers are just eye popping. That's putting it modestly. How do you evaluate the timeline of when these massive investments actually end up flowing through to the companies that benefit in these buildouts? And how much of it is generally priced in before the numbers are reported in earnings? This is a two-parter question. I think the second part there, Oracle, which we talked about a lot in this episode, is a great example of that, right? Forecasting this revenue out to 29 or 20 or 30 before it's necessarily hit earnings. So anyway, Eric, what are your favorite metrics, and how do you think about these hyperscaler buildouts, given that we're now talking about 3, 5, maybe even 6-year investment timelines?
Yeah. So it's a good question. It kind of sums up the whole game, right? So, you could talk for a long time about this. For me, I start a lot of people might look at company specific metrics. I start looking at the overall opportunity. I'm looking much more at markets, I'm looking much more at technologies, and then I work my way backward. I don't always need to understand everything about a stock to make a purchase on it if I'm comfortable about the overall market opportunity. I've heard a phrase before that the day you'll know the least about a stock is the day you buy it, and I believe that to be true. And many of the greatest investors, like a Stanley Druckenmiller, will say
Hmm.
part of their advantage is they don't. There's a point where you get diminishing returns on knowledge,
Yeah.
and if you pause yourself with paralysis trying to know everything about a stock, you often miss out on kind of the periods where its opportunities, its growth areas are undervalued by the market. Perhaps we've done that with some of these neo clouds because it's been something I've been looking at. It's just we haven't made any active recommendations. We've talked about things like Applied Digital, but this is maybe an example where we maybe should have just pulled a trigger and gotten some level of exposure earlier, and we were too busy in paralysis of analysis. So I would say, how do you know that something's not priced in by the market? I believe that the markets, especially with exponential trends, is not as efficient as we believe it is.
Hmm.
The human mind doesn't think well in exponentials. I think it gives you an opportunity to often buy things where growth is underappreciated. I also think until nuanced technologies hit, they are often underpriced. We've talked about in areas like how we're playing the growth of this scale up, scale out, scale across architecture. You can look at a roadmap and know how one technology leads to revenue for the next, leads to revenue for the next, but the market doesn't always price it that way. It's why I believe things like liquid cooling are underpriced because you look at what's one of the best performing stocks, it would be Comfort Systems, which does a lot of air conditioning for these data centers. I believe that's something that it's already been seen in a lot of growth because it was a favorable technology for prior generations. But I don't believe, again, I would believe that some of these other technologies like liquid cooling that haven't actually been deployed are still underappreciated. So, to put that in concise terms, I look for areas with exponential growth that I think are fundamentally limited by the human mind and underappreciated. I think that gives you advantage. I look at markets first, and third, if I'm comfortable with a market size and I have what I feel like is a reasonable understanding of how revenue will flow through in the opportunities, I try and make investments in things that I believe, if you're an expert in the industry, you might believe are fully baked in, but I believe are generally underappreciated. And we've seen this scenario play out time and time again across various AI markets.
God, Eric, I want to leave it at that because that was such a world class answer. But I did say I'd answer it myself, so maybe we just edit this out because that was really good. But I'll answer two parts of this question, which is, yeah, we are talking about the AI investment portfolio here, but the first part of this question is when evaluating a stock idea, do you have any favorite metrics? So I'll say, in general, for like, we don't only own AI and tech companies. So if we're talking about general, maybe a consumer goods company or a real estate company or whatever, more a more run of the mill, non-exponential company, I like to look at revenue growth, price to sales ratio, price to free cash flow ratio. If it's a little bit more mature, one of the things I like to look at also is share issuance. Companies can grow really fast and dilute themselves even faster. So you want to make sure that they're not diluting themselves. So I like to, if I'm looking at more traditional stocks, those are some of the metrics that I like. But as you said, exponential growth is extremely hard to comprehend. And there's another book recommendation. Maybe we'll do the AI Investor Book Club. I really liked Enlightenment Now by Steven Pinker. And that it sort of talks about the long arc of humanity. But if you want to understand how powerful human ingenuity can be, looking at a book like that and looking at the long-term charts of things like, advancements and in every form of technology and lower crime rates and just what the human mind is capable of when compounding over long periods, it helps you appreciate a little bit more what can happen over long scales of time when you just let humans innovate and let them compound. So I really like that your point about thinking about exponential growth a little differently, and I do frame it differently. If we're thinking about sectors that can compound like this, you you can't get too hung up on trying to model what will happen in 24 or 36 months because it's inherently unknowable. It changes so fast, but consistently, time and time again, it changes much more to the upside and much faster than people can appreciate, particularly if you let it run. So I sort of separate my investing metrics based on if it's an exponential industry versus a more stable, traditional retail or consumer goods, industrial type stock.